Good morning. Thank you for joining us today. I'm James Kim, Chairman and CEO of AMCHAM Korea. Via these webinars, we're trying to help the AMCHAM audience. This is our 24th webinar and probably the most important for many of you participating. After all, it impacts your money and for your loved ones. Today's webinar is called Tax Implications for Foreign Individuals in Korea. We're so privileged to host Kahng and Paul Manning, two foreign attorneys from Kim Chang. Kahng is also AMCHAM's Taxation Committee co-chair. He has extensive experience in tax advisory and counseling strategy in Korea. Paul Manning has over 30 years of experience on international tax matters. He has had extensive experience working for the IRS. And today, he is on our side. To seek this type of advice from top professionals such as Sean and Paul, it would be a very expensive session. I want to thank Kim Chang for helping the membership of AMCHAM with this valuable information. We're also going to have opportunities to have the audience ask questions. So for those of you who have questions, please use the chat button to ask your questions. And now, let me turn it over to Sean and Paul. Thank you very much.
Well, good morning and welcome to our program today. And I want to thank Jim and AMCHAM for the opportunity and for the gracious introduction. As Jim mentioned, our program today is about cross-border tax implications for individuals who are in Korea. And we're going to focus a large part of the program on US taxation, but also on Korean taxation. We will get into income tax, estate tax, gift tax, and several of the issues that arise in connection with those. So again, we just want to thank AMCHAM and Jim for the opportunity. So this is our agenda. We're going to start off talking about some basic concepts. What are the differences between being a citizen or a resident or a domiciliary? Why does that matter? We're also going to talk about sourcing, where the income is, quote, sourced, and then get into, as I said, the income tax considerations, the estate and gift tax considerations, and then finally, we're going to share with you some of the common compliance problems that we've seen in our practices, and then some ideas on how to remediate those problems. And as Jim mentioned, at the end of the program, we do have time for questions, and we would love to hear from you. Well, this is Ben Franklin's famous statement, and when the idea of having a program about taxation and estate tax planning came up, this seemed like a terrific place to start. In this world, nothing can be said to be certain except death and taxes. So one point we want to emphasize in the cross-border context, which is more complicated than I think Ben Franklin had in mind, is that it's not simply about trying to reduce taxes, but in the international context, it's also very important to focus on double taxation. So in our hypothetical situation here, a US individual is probably going to be paying taxes to the United States and also Korea. And unless proper steps are taken, there's a very real possibility of being subject to double tax. And we'll get into later some of the techniques and strategies and legal ways there are that can be used to avoid double taxation. So we wanted to put up this graphic. As many people know, tax is complicated, but at times it can seem easy. There's a simple rule like something is subject to tax or something isn't, or what is the tax rate, what is not the tax rate. But when you have 10 or 20 or 30 rules all falling at the same time, and then in international context, it can get very complicated very quickly.
Yeah. There are a lot of maybe clear rules out there, but when the clear rules interact, sometimes there's no clear answer. And taxpayers need to take a certain position, without really knowing whether it is going to be successful or not. So the complication, as Paul mentioned, comes in the interactions with many different rules and regulations.
That's right. And part of the problem is that tax authorities are always playing catch up. And what I mean by that is they write rules, but then the types of transactions there are change and the world evolves. And so oftentimes there are transactions and situations which are not covered by rules. And so as Sean mentioned, you're forced nonetheless to take a position on your tax return with some uncertainty. So let's get into it. Citizenship versus residence-based taxation. So any of you U.S. citizens or U.S. green card holders who are attending today's program know that you're going to be taxed on your worldwide income wherever earned. And the U.S. is unique in that way in treating citizens as being subject to all of their tax wherever they are residing. Most countries have residence-based taxation. So for example, if you are a resident of Australia, you're going to be taxed on Australian sourced on your worldwide income in Australia. But if you leave Australia, even if you're an Australian resident, you will not be taxed on your worldwide income. You would only be taxed on your Australian sourced income. And I did mention this concept of sourcing. Sourcing is a tax concept that we use to identify where the income arose. So for example, if you have property or stock or bonds owned in the United States or owned in Korea, any gain associated with that property is going to be sourced to the location where the property is located. Similarly, if you perform services and earn income in a location, the income associated with those services would be sourced in that location. So for example, I am working in Korea. My Korean services income will be sourced in Korea. So sourcing is a very important concept in international tax. The second, or the third point we should talk about are tax treaties. Most developed countries have bilateral tax treaties, and the purposes of these treaties are to eliminate double taxation. The way that the treaties do that is by allocating the taxing rights to one jurisdiction or the other. So these treaties are very helpful in sort of the big problem I was talking about earlier about having to avoid double tax. There's also this concept of a savings clause that United States treaties have, which we can talk about it more later, but it saves for the United States the ability to tax U.S. citizens and green card holders, notwithstanding the treaty. So you can think of, this treaty as this work of art that is negotiated between parties, two different countries, and creates taxing rights for one or the other. And so that's a beautiful thing. But then the United States usually includes this savings clause, which to a large extent might, sort of gut the treaty of all that double tax relief. So there are other ways that the double tax can be relieved. But since there's so many U.S. folks, I think, involved in today's program, we wanted to highlight that. Sean, what about domiciliary-based taxation?
Yeah, we'll just briefly touch on this concept. There's like a residence concept and domicile concept. And I think in the UK, UK uses in the domiciliary concept in income tax context as well. But for US purposes, domiciliary concept kicks into only in the estate and gift tax context. And domiciliary is different from residence concept because the domiciliary is more of a intent to where you intend to stay, and it is kind of connecting past, present, and future. I mean, if you are out of your home country, you have that intent to go back to your home country. Then your domiciliary is your home country. So in the U.S. context, as I mentioned, it only comes into estate and gift tax context, and it is different from income tax residence concept. But in Korea, it's the same. I mean, I'm going to discuss Korean once a little more, but then in Korea, only one concept applies. That's the residence concept. So it's a little different from the US side. Yeah.
Well, and a common problem that can come up is that when people are living their lives, they often don't take into consideration these questions about intent. So you may be a US citizen, you start working in a foreign country, you may not have an intent to remain there indefinitely, or you might, or maybe you just didn't think about it. And then lo and behold, at the end of the year, your tax return preparer asks you these things, and then you're left trying to figure it out. And so I guess part of our program today and the message is about thinking about these issues before it's too late. So let's go over some of the basic rules that apply to US citizens living abroad. And I included residents, which basically means green card holders. To be a US resident, that's a lawful permanent resident. Or it could also be someone who passes what's called the substantial presence test. If, for example, you were in the United States for more than half the year, 183 days, you're going to be considered a resident. And for these individuals, you're going to be taxed the same way that a citizen would. You'd be taxed on your worldwide income. And as we mentioned earlier, that's a little different than other countries. So if you're an US person living abroad, say in Korea, you do have several tax benefits available to you. One is the foreign earned income exclusion. So if you were a Korean resident and a Korean taxpayer here, you might be eligible to exclude $107,000 from your gross income. That can be very helpful. There's also a thing called a foreign housing allowance. This is a deduction given to you for housing expenses here, but that one is more limited. That has to be a housing expense that your employer pays for and that you take into income, and so that the US giving a deduction kind of evens out, takes it back off of your tax return. There's a thing called a foreign tax credit. So if you are living and working in Korea and paying tax to the Korean government, when you file your US tax return, you will get a dollar for dollar credit in most circumstances for the taxes you paid to Korea. So that's a very powerful provision. And we also wanted to put in a note about state tax issues. This is an area where you really need to be careful, because most states have residence-based taxation, and it's similar to the concept we were talking about earlier about countries and jurisdictions having residence-based taxation systems. So, for example, the state that I used to reside in, Virginia, considers you to be a resident as long as you, for example, maintain a driver's license and vote in Virginia. And that doesn't even matter if I moved physically to Korea and lived in Korea for 5-10 years. And so there's these presumptions that exist. And so you might, for example, if these types of rules were applicable in your state in the United States, you might cede your driver's license or not vote in the state election. There's also questions about real property ownership. If you own real property in your prior state, is the house sitting vacant? That makes it look like you might be returning to the state, or are you renting the property and using it as an investment, which would say the opposite. So, these are several layers of problems, not just federal and not just Korean, but also state-based. One common issue that we see in this area that I want to veer off the slide for a little bit is the problem of sort of accidental American status, and also green card holders or even US citizens not understanding their obligations. So just to go back, when I say accidental American status, if you were born in the United States and the next day left the country and have lived in Korea ever since, you're still an American citizen and you should have been filing tax returns all of those years. And that can be quite a problem if you're now, say, 20 or 30 years old, trying to figure out how to handle that. But it's a very understandable problem because not everybody expects to be subject to this citizen-based taxation. Final point on the slide is The United States and Korea, as we'll go into later, has information reporting requirements with respect to international transactions, foreign-based assets, foreign bank accounts, and those rules are very important to pay attention to. They're not returns that require you to pay a tax. It's really about providing information. However, the failure to provide that information in a timely manner can lead to tax penalties and other problems that we'll get into later.
So I'll talk about the Korean income tax side a little bit. So one concept you need to understand is that in international tax setting, the nationality or citizenship is probably the least important factor when you consider where you should be taxed. Because a lot of countries, they have a residence-based taxation. If you are a resident of Korea, it doesn't really matter your citizenship or nationality. You will be taxed just like any Korean citizens or Koreans living in Korea. So then who becomes who is a resident of Korea for tax purposes? Korean tax law provides actually two different concepts of having address, that's one concept, or you have a place of residence in Korea for 183 days or more. So one is more of a address. It is a direct translation. When you look at some other literatures or even Korean government website, it is translated sometimes into residence or sometimes into domicile. So there's a little that the arrow dot actually says that address is determined based on objective tests such as the existence of family living together and then you're properly located in Korea. It's a they say it's objective test, but the Korean tax authority can make many kind of somewhat argument that's stretching too much. But anyhow, so if you have an address, you have a domicile in a sense in Korea, you are a Korean resident for tax purposes, or if you stay more than 103 days or more, then you become Korean resident. So at that point, you get started taxed as a Korean resident, which means you'll be reporting and paying tax on all your worldwide income in Korea. That's what's being Korean citizen. And it doesn't really matter whether you're a US citizen or UK citizen, it doesn't really matter. That's not the standard in international tax setting. So, there's a few kind of interesting rules in Korea. I called it like a 5-year rule. So when you look back the 10 years from your the one end of the tax year, and for 10 years you've been here for 5 years or less, up to 5 years, 5 years or less, then even if you are a Korean tax resident, you only get tax on your Korean source income, what you earn in Korea, what the money you make in Korea. So 5 years, 10 years out of 5 years, you've been staying here less than 5 years, 5 years or less, then you only pay tax on Korean source income. That can be very important. If you have overseas source income, and beyond five years, you need to pay tax on your worldwide income. So this 5-year rule is very important. And the second one is the flat tax rate. It is for your wage and salary income. It's not the business kind of income. You have to work for someone. And if you're a foreign national and if you work here and you work for somebody and then get paid your wages, salaries, then you can actually choose applying this 19% flat tax rate. With the local income tax, it becomes 20.9%. So, and this one is not the 5 out of 10 year standard, it's 5 consecutive years. So 5 years you work in Korea, and then 6th year, you cannot choose to apply this 19% flat tax rate. So, 2 5-year rules, 5-year rules for just, paying tax on your Korean source income, and the other 5 year rule, that's you can choose to apply the 19% flat tax rate. And the last point, year-end tax settlement is in Korea. One major example is that earning only wages and salary income. If you only have wages and salary income, you don't actually file tax return because it's done by your employer. So you never actually see the tax return or sign anything because your taxpayer can do it for you. So you don't have to be kind of surprised. I mean, the government, your employer comes to you and then they'll take care of your tax return. That's what this means, year-end tax settlement.
I bet there's many United States people who wish that was the rule in the United States. Unfortunately, it is not. I want to touch on one thing that Sean alluded to, this concept of residency and domicile. And we sort of often get the question, well, what if I have a mailbox in the United States or in Korea? Can I use that to count as my residence, or I have a house that's vacant? That would be dangerous because both Korea and the United States, and I think worldwide, jurisdictions will look to the substance of the situation. And so you can, take the position that an empty house is your residence, but that would probably be wrong. And signing a tax return is usually done under penalties of perjury. So that would probably be a crime. So we would definitely advise against taking that sort of a position. Just remember the substance of what is going on is going to be, the determining factor. So we thought we'd talk a little bit about capital gains, both Korean and United States. So capital gains are basically when you own and sell stock, bonds, real estate, really any type of property other than property you've used in your business, and then experience or have a gain on the property. There's different rules for that. In the United States, for example, if it's a short-term capital gain, which means you held the property for 1 year or less, it's treated as just ordinary income, as if you earned it from performing services. But if it's long-term capital gain, where you held the property for over 1 year, then you're going to have preferential rates, 0% on capital gains if you're in a very low income threshold, 15% in a middle category, and then 20% capital gains rate for people that make significant money. That's probably around, I think it's around $400,000 or something is when the 20% rate would kick in. Nonetheless, that's still a lot lower than the rate you would otherwise pay, which the highest tax bracket in the United States now is, I think, 36%. So I alluded to earlier, our United States-Korea income tax treaty has this exemption provision on capital gain for non-real property that is sourced in the other jurisdictions. So for example, if you are in Korea in the first 5 years and you have US capital gain, you would be exempt from Korean tax. It should apply that way, but as I mentioned earlier, when you reverse the facts, the United States also has that treaty provision, but also has this additional provision called the savings clause that it's going to allow the United States to tax that capital gain. You will, so for example, just to clarify, if you had capital gain on Korean sourced property, you will pay Korean tax on it, and then you would report that income on your US return, but get a foreign tax credit to the extent you paid Korean tax. And basically, the bottom of the slide, the same is true with respect to real property transactions, even though there's particular treaty provisions on those.
Yeah. So I think a lot of U.S. citizens get confused about, as long as we just pay tax on Korean source income into Korea and U.S. source income to U.S., that'll be fine. But it doesn't work that way. Even if you are a U.S. citizen, you are a Korean resident for tax purposes, you have to report worldwide income. And then if you are a citizen, U.S. citizen, there's another layer of obligation for the U.S. side because you have to report file U.S. tax return too. That's very unusual, but I think for being a U.S. citizen, that's something you have to do.
Right.
Oh, so This one is actually the U.S. net investment income tax. This is a U.S. one, not the Korean one. And it is not, although it says a net investment income tax, it is not necessarily income tax. In a sense, for this the tax you pay in the U.S., U.S. government does not give foreign tax credits. So for example, you have interest income, dividend income, or rental income, or even capital gains that generates this passive income in Korea. Then you have to pay this net investment income tax. The rate is 3.8%, so it's a very little, but then they don't give you foreign tax credit. So if you pay tax on the Korean source dividends in Korea, when you pay net investment income tax in the US, they don't take that into account. So there's a double tax impact on that net investment income tax. And the threshold is for married filing jointly is 250, which means that that's the modified adjusted gross income. So just simplify that your gross income is 250, less than 250, then you don't really pay this net investment income tax. But then it's a 300K, then you have to pay lesser of this passive type of income or the amount above 250. So it's a little tricky calculation, but more or less you're safe until 250. And this provision does not apply the non-resident in the America, and then the green card holders making tie break, so to treat it as a resident of another country. So for this tax, I emphasize there's a double tax impact, and the rate is low, but it can actually have sometimes the only tax you pay in the U.S. is actually this tax if you have a lot of passive income.
Yeah, and we threw you a bit of a curveball there because this is a U.S. provision. Mm-hmm. Sean is a U.S. tax lawyer also, so he's the smart guy in the room. I want to talk a little bit about treaty tiebreaker. This is a very important provision. It kind of applies one way. It applies to non-U.S. citizens, but to U.S. green card holders would be a good example. So if you are a Korean citizen and you hold a U.S. green card, we know, as we discussed earlier, the green card signifies full taxation in the United States. But there's this provision in the treaty that allows you to tie break, and under several fact-based questions, you can determine whether you are closer, more closely connected to Korea or to the United States. And if it turns out that you're more closely connected to Korea, then you can assert your rights under the tax treaty to be taxed as a Korean, and then things would change dramatically. That would classify you for United States tax purposes as a non-resident alien. You would no longer be taxable on worldwide income in the United States. Your U.S. tax return would be a lot simpler, and you would only be taxed on your U.S. sourced income. You would, however, having chosen to be taxed in Korea, now be subject to full taxing rights by the Korean government. And the last point, dual status, as tax people, we like to have all these different terminology. It's not just to confuse people. We're actually trying to keep our own wits about us. Dual status is when you are part year Korea, part year United States, and you would sort of allocate proportionally. Go ahead.
So we are, I'm back to the Korean tax, but before we go into the Korean capital gains tax, the basic concept is if you are a U.S. citizen or UK citizen or other country citizen, and you live in Korea and you are a Korean tax resident, then you pay tax on worldwide income of yours. But then it is foreign source. A lot of times the source country will tax that income as well. Then when you file your Korean tax return, you get foreign tax credits. So usually there's no double taxation. So that's something you need to kind of remember. Double taxation a lot of times makes the tax treaty allows avoiding the double taxation. But then sometimes the tricky question is you're a U.S. citizen and you have a U.S. source income, and then you have to pay Korean tax, and then you fully report and you go back to U.S. That can be a little bit tricky, but then that's a little bit more complicated issue. So we'll maybe cover it in another time. And so Korean capital gains rule. In the U.S., when you file tax return, you report all income together. But in Korea, capital gains are reported separately. It is not included in your so-called comprehensive income tax return. Although it says comprehensive, it's not really comprehensive. You report all the other income, almost all the other income, but the capital gains tax is separately reported and paid. And so capital gains are imposed. Capital gains tax are imposed on then the gains from transfer of real property or stocks, and then those type of things. And in Korea, it is actually listed. So something's not on the list, you don't really pay capital gains tax. But this is a major items that you can see on the list. But one thing that's very interesting in Korea is that the second bullet point, as long as you are a so-called large shareholder of in a company, basically, then you don't really pay any capital gains tax as long as you sell these shares in the exchange, on the exchange. So when you so large actually shareholder is a defined term. It doesn't really mean that large. I mean, it's a threshold is relatively low. From I think starting next year is going to be 300 million Korean won, so $300,000 US approximately. Then you have more than that. Your holding is values more than that. You are considered large shareholder. Then you have to pay tax. But a lot of times, people don't fall into that category. So then you don't have to pay any tax. So there's an implication in the U.S. tax filing, because this capital gain, you sell your stock in the stock exchange, then you don't pay any tax in Korea. So you sometimes forget to report that in the U.S. So when you file U.S. tax return, you don't look into Korean actually tax law. You look into U.S. tax law. And U.S. tax law, this type of income, the capital gain is taxable. So you have to include this gain into in your U.S. tax return, even though it is not taxed in Korea. So being a U.S. citizen is in that situation, you're not very happy occasion, I guess. So, so capital gains tax rate actually varies quite a bit. So I just listed just a few examples. And if you're a large shareholder and then held the shares less than a year, then it's a 30%. And then something. So you're a large shareholder up to 300 million Korean won, 20%, above that 25%. And the sale of foreign stocks, that's not necessarily a large shareholder. The tax rate is 20%. So if you add the local income tax, it's 22%. So if you sell stocks overseas, that's the rate you need to apply. But then if you pay a tax in the source country, if you pay over there somehow, then you reduce that much. But a lot of times you are a Korean citizen, capital gains are not taxed in the source country. So you need to probably apply the 20% overall tax rate. Any comments? No?
No.
Okay. So this is an interesting issue, that the real property transaction. Probably you noticed that in Korea that the Korean government is very much interested in controlling, maybe trying to prevent the housing prices to go too high. So there are many different rules applying to the house, owning the house and then selling. Then there's a lot of different complicated tax rules apply. And overall, the realized transaction tax, different tax rates and deductions apply to depending on types and where will you have that property and how long you had it. And for house, the residential houses, it also depends on how many residential houses you own. So for foreign expat, probably you don't, we are not going to own, a lot of buildings or the houses while we are here. But then there's one kind of, we call it, maybe it's an oasis in this complication of a very kind of, kind of heavy, the high tax rate for the real estate gains, capital gains from real property, is what we call like a one household, one house kind of a regime. If your family has only one house in Korea, and you owned it at least 2 years, and in certain areas you have to occupy it for 2 years, then you don't pay tax capital gains. You don't pay tax on capital gains up to $900 million, 900 million Korean won proceeds. So that's your selling price. So when you sell something approximately 900,000 USD, then you don't pay any capital gains tax. And above that, they have a very generous deduction. So if you own it, it's every year there's 8% increase. So if you own that property 10 years, that's your only house for 10 years, the deduction rate is like 80% of the capital gain. So if you have one house, your family owns one house, and you meet this occupation and the ownership requirement, and you own it quite a long time. And even if you have a lot of capital gain there, when you sell it, you pay really little tax on that. So this is something very unusual, I think, when you compare it with, I think, other countries, although US actually provides some exemptions as well. But this one is one benefit even expats can use. And the second the bullet point is sale of a real property overseas. I mean, you might want to claim that you have one house overseas while you are here, and that's your your residential house. Maybe you can try to claim that and take advantage of this one household, one house rule. But that doesn't work that way, because this one household, one house rule applies only houses in Korea. So the second point, second sales of a real property overseas, the point is that while you are here, if you are here less than 5 years, you don't pay, because you, as I mentioned at the beginning of this seminar, that you pay only Korean source income. But after 5 years, after 5 years, you have to pay tax on that gains from overseas sale of your real property. And the capital gains rate is just the ordinary income, the rate. So highest marginal rate is about 42%. So when you sell real property overseas, while you're here 5 years or less, you don't pay Korean tax. But beyond that, you have to pay Korean tax. So that's something you need to remember.
Right, and just before we think it's too easy, you could sell property and trigger capital gains in those 5 first years, but you kind of won't have that gain after 5 years in Korea. But it will involve a mathematical calculation, because you're going to be paying tax on all of that gain in the United States when you trigger that gain, and that loses for you the benefit of deferral, which means if you had sold that property 15 years from now, you would pay tax 15 years from now. And so the time value of money would matter. So it's not as simple as get out in 5 years. There may be some situations, and Sean wasn't saying that, but I think it's what we were referring to earlier about how this is a little puzzle that needs to be evaluated.
Yeah.
So we'll get through this slide fairly quickly. We've referred to a lot of these provisions already. There's a treaty between the United States and Korea, and you can Google it and pull it up. I know it's available from the IRS website. The general rule is that dividends, interest, royalties are going to be taxed in both jurisdictions with a foreign tax credit available. For individuals, look to in the dividend context, it's a 15% rate under the treaty, and the 10% rate would apply to corporate recipients, 12%, and that's a maximum. So if you earn interest in Korea, the most that Korea can tax a U.S. person living in the United States on that interest is 12%. And then, of course, the U.S., you would pay tax on the interest and get a foreign tax credit. Royalties, same thing. Korea can impose a maximum 15%. The U.S. would take it into income also, but give you a foreign tax credit. The 10% rate there is a special provision that applies to copyrighted material like books and films. And since we covered capital gains and we have more to cover, I think I'm going to move to the next slide. So I mentioned earlier the importance of international information reporting. And before we talk about these particular forms, I think we should focus on sort of the second to last bullet point, which talks about penalties and statute of limitations issues. For example, if you have 10% ownership, if you're a U.S. citizen and have 10% ownership in a foreign corporation, you would be required to file that Form 5471 to report basically the financial activity of that foreign corporation and how it impacts you as a shareholder. If by chance you failed to file that form, your statute of limitations does not start to run. Let me say that again. If you did not file that form, your statute of limitations does not start to run. So you could have filed a tax return in the year 2000 or the year 1990, owned a sufficient amount of stock in a foreign corporation, and if you failed to file that form, the IRS can still assess tax against you 20 or 30 years ago. And then when you think about the taxes and the penalties associated with that, plus the fact that there are, interest, plus the fact that there are penalties, it can turn into quite a healthy nugget. And so you really want to, as you're preparing your tax return every year, you want to be fully, disclose everything to your return preparer and make sure that you get all these forms in, because there are significant statute of limitations and penalty issues. So the first form, 8938, is where you essentially have to report foreign assets to the IRS. That's bank accounts, other types of sort of liquid assets, stocks, holdings in mutual funds. The next one, 8833, that is if you are taking a position that a treaty helps you relieve some of your double tax, that's required to be filed. 3520, we see this come up in high net worth individuals who are making gifts or creating trusts on behalf of their beneficiaries. Very particular rules that kick in. We're going to talk about them later, but this itself is just an international information reporting requirement that, as I said, carries with it penalties and statute of limitations implications. I want to jump down to the foreign bank account reporting. This is not an IRS form. This is a form that is, it's required by the IRS's parent, the Treasury Department, and it relates to a different statute, not the tax code, but to the Bank Secrecy Act. It's really about, as my understanding is tracking foreign bank ownership for purposes of fighting terrorism and money laundering and things like that. You may not be doing any of those nasty things, but you're still required to file this form if you have $10,000 in a foreign account. And the penalty for failing to do this can be quite significant. If there's a willful failure to file, and we haven't really talked about the difference between willful and non-willful, but willful means you're supposed to do it and you just don't. The penalty can be very high, up to 50% of the account value. And that is not just an account that you own, but it's one where you have signature authority. So if you're a director of a massive corporation and you have signature authority over a bank account, you can sign checks for the corporation and you fail to follow this form, get some help and try to figure out how to remediate it, because the penalty can really take quite a bite out of your pocketbook. And then lastly, just the last bullet point we talked about earlier, foreign earned income exclusion, foreign tax credit, all of those things, in order to get the benefit, you have to file these forms. And I don't mean that in a bad way. Everything sounds negative when you talk about tax. These forms actually help you figure out the right amount of tax, the right amount of foreign tax credit you're entitled to. And, if you don't want to hire a return preparer, and you look at these forms, and they often have very helpful instructions that have all sorts of situations in there. And so you can go in there and, give it your best shot of figuring out what you're supposed to do.
Okay, so coming back to Korean side, so I think for Korean tax information, I think in this seminar, you need to remember just a few things, like those are 2 5-year rules. The one that first 5 years working for the employer here, your wage income and the salary income can be taxed at 19%, including the local tax like 20.9%. That's your choice, first 5 years. And there's another 5-year rule that the 5 years out of 10 years, the past 10 years, if you stayed here 5 years or less, you only reported pay tax on Korean source income, what you earned in Korea. So even though you are a Korean resident, you don't get taxed on the worldwide income. So beyond that 5-year period, you pay tax on worldwide income. So, and Paul mentioned that maybe 5 years, we are not suggesting you just get out of this country, but that, this is the information return we need to file. If you own like 10% ownership in the foreign company, or if you have a real property in overseas, you have to file this information return as well. And this requirement kicks in actually after the 5 years. So the 5 year, the threshold is quite significant. And also beyond that 5 year, the 5 out of the 10 year, that beyond 5 year, that threshold, then you need to file the Korean FBAR as well. Korean the bank account, the foreign bank account reporting regime as well. So 5 year the rule is rather significant. If you stay more than 5 years here, then you have to have this information requirement, worldwide income, tax on worldwide income, and also this Korean FBAR. Although Korean FBAR, the reporting threshold is a lot higher, and in the US it's only 10,000. I think that's very low, but over here it's 500 million Korean won. That's roughly 500,000 USD. So, so when you hit the 5 year period, the threshold, you need to think about these things as well. And I listed some statute of limitation for tax. In the US, it's 3 years normal, and here it's 5 years. And non-filing 7, it has some international transaction, it extends to 10 years. And you are trying to evade tax, and 10 years, and then overseas transaction, it extends to 15 years. So.
Well, this is where we started, and so we're going to transition to the next part of the program. We just talked about Korean, U.S. cross-border income taxes and information returns and capital gains. So now we're moving on to the next phase of taxation after you die, estate taxes and gift taxes. And I said to Sean, I said, what happens after you die? And he told me this: in this world, nothing can be said to be certain after death, except for taxes. So as it turns out, after you die, taxes live on, and we're going to move into that part of the program now. But before we do, we wanted to have this graphic to demonstrate the point we've been making all along, which that it's pretty tricky not only are you trying to minimize your tax, but you're trying to be, intelligent about the way you conduct your affairs, and at the same time avoid being subject to double taxation.
Yeah, and in income tax area, there are a lot of income tax treaty between and among countries, right? So there are so many, thousands of them, altogether. But then estate and gift tax treaty is not that many, and Korea is not a party to any of them. So double taxation potential is really there. If you are a Korean resident when you die, or when you get a gift from someone else. Yeah.
Okay, so I'll do the U.S. estate and gift tax considerations. So if there's good news and bad news, when you die, that's going to be your last Form 1040. And it's, from the beginning of the year up until the day you die, that's your tax return for 1040. After you die, perhaps not surprisingly, you don't have to file another Form 1040. Bad news, and perhaps, yes, surprisingly, is your estate has to file this 1041, and that is going to be an annual reporting requirement for all of the income that you're receiving even after death. So for example, if you're getting dividends, annuities, anything that is continuing to pay you rental income after you die, that's all going to be taxed to your estate. It's as if you were still alive, but it's called your estate now, and your estate has to declare all that income, pay taxes on it, file this Form 1041 until there's a final distribution of your assets pursuant to your will or probate. So you would think that might be enough, but that's not the end of the story. If you have a sizable estate, roughly over $12 million, and that's a limitation that is phased out after 2025. This was put in by the Trump administration several years ago with U.S. tax reform. That's going to be cut in half after 2025. So you'll have roughly $6 million. So nobody wants to hurry up and die, but this is going to be a big change. If your gross estate exceeds that amount, then you're going to have to file this Form 706. The form would allow you to remove that 12 million or 11,580 out of your return, and then only the excess of that would be what the taxable amount would be. We talked about the next topic, gift tax. This is domiciliary based, so it's not necessarily where your residence is. It involves concept about where you intend to stay. A few helpful provisions in the U.S. gift tax law. You have an unlimited ability to give gifts to your spouse. And I think that's because it will still be included in your spouse's estate. So there's sort of a built-in mechanism that prevents double taxation. And it's also just a recognition that spouses, as a matter of policy, should be allowed to give each other gifts without the tax man being involved. Not necessarily the case if you have an alien spouse. It's a sizable limitation. You can give an alien spouse $155,000 annually and not be subject to gift tax. So you notice the tax policy is a little bit different in that circumstance. And then you have an annual exclusion of $15,000 per person. Think of your children. If you many times will see wealthy individuals that are trying to figure out how to manage their estate and gift obligations, you can give $15,000, you and your spouse both, to each of your kids every year, and there's no implications to it. I also want to mention two very important ones that are probably less known, and that are gifts for medical purposes, for education, and I said two, but I meant three, and charity. It's not, those are not going to be taxable gifts. So you can donate to your church, you can pay for your child's or your grandchild's education, or you can fund an education account or pay for somebody's medical bills. Those are not going to implicate the gift tax. And while, if you think about paying $100,000 to a child's education fund, If you're very wealthy, that doesn't seem like a lot of money to be doing estate planning. I would look at it in terms of how the recipient views it. The recipient, it is a lot, and it is very meaningful to their lives to receive that. The same can be said for your church or other charitable organizations that are the recipient of these gifts. Double tax relief, the U.S. will allow foreign tax credit for foreign estate taxes paid, but that is not the case for foreign gift taxes. So in gift tax law, you're going to often be subject to double tax, as Sean mentioned earlier.
So coming back to Korean estate gift tax, you might ask, why do I have to care about, Korean estate and gift tax? Because, you are a Korean tax resident, you are subject to Korean estate and gift tax. The Korean estate tax purposes, the Korean resident dies, then the worldwide asset he or she owns is going to be subject to Korean. In Korea we don't use actually estate tax. Maybe we have to change it. Korean inheritance tax. So I just wrote it, tongue-in-cheek, kind of say, planning idea is don't die as a Korean resident, but it can be a really important point, because you have all the assets maybe you own in overseas, not in Korea, but then you live here long and you die here, then all those assets probably will be taxed in that where the assets are. Because that's usually what happens. Even if you are not the resident of that country, if assets are there, usually you have to pay inheritance or estate tax over there. But then all the assets are taxed in subject to Korean inheritance tax as well. So being a tax resident has a very could have a very serious implication. So for estate tax or inheritance tax, the standard is the person who dies, that person is a resident, then his or her assets worldwide assets are subject to Korean inheritance tax. Gift tax is a little different. It is the donee is actually a resident, someone who receives, but there's so many exceptions there. It actually doesn't really do the justice. So if you are a Korean resident and you receive a gift, then that gift is going to be taxed by the Korean government. It doesn't really matter where that asset is, because you are as a donee, you receive that money from someone overseas or from within Korea, then is subject to gift tax. And marginal rate over here is rather in the US is 40%, but in Korea it's 50%. And as Paul noted, that in the US you have a lifetime exemption of almost like $12 million or 11 point some million dollars. But in Korea, it's a very complicated calculation. But I say maybe up to like 300,000 that to your, for inheritance tax, about 300,000 US dollar exemption for your spouse. Maybe that's the max you can get. So anywhere over 300,000 USD or 400,000 USD, you are looking at the 50% marginal rate. But then Korea actually provides that the foreign tax credits. So a lot of times, you don't actually get double tax, but because it's a domestic law, it's not the treaty basis. There's always that potential of being double taxed on the same asset. So I'll just finish that over here. Yeah.
So we know we're close to the hour. We did build in 15-minute cushion for questions, and we have.
Do you guys have a few more wrap-up slides, or should we try to give the audience an opportunity to ask them questions?
I want to make just one point
Sure.
that is related to something Sean said, and I said earlier, which was that the United States typically will give a foreign tax credit on an estate tax paid to Korea. And I just don't want everybody to get too comfortable with that, because like everything in tax, there are limitations to the extent that that foreign tax credit can be used. So that also involves planning. So with that, Jim, we'd be glad to field yours or other questions.
Yeah. Hey, before I open it up to the audience, and we have some very interesting questions from the audience. I want to thank both of you, Paul and Sean, for doing this presentation. We've had a lot of webinars, and to be candid with you, this is one of the best I've been able to witness for myself. And I think for many foreigners living in Korea, you guys have given us a lot of really valuable information. To be candid, I'm not sure if what you guys did was positive. A lot of depressing news out there. But I think it's important that we all know the facts, that we're compliant, and we try to get ourselves educated. This 5-year, term, I think is quite interesting, right?
Yep.
Many people are trying to answer the question, should I leave after 5 years? And these are all the things that I think we as AMCHAM will have a discussion with, with our friends from the U.S. and the Korean government as well, because this is a very important topic. But the good news is we're a lot more educated today than ever. And for those people who have more specific questions, obviously they can, contact you folks or contact other professionals that have more details to talk about. So let me just ask you a few questions from the audience. Here's a question from one of our board members. His question is, he wants to ask about foreign income credit for the company. So if the company pays $300,000 in Korean tax, can the company actually get credit or get dollar for dollar back when they file the U.S. taxes?
So obviously, we caveat everything we say because we're lawyers and we would need to know the full circumstances. But if you are as I understand the facts, a U.S. person with ownership in a foreign corporation and that foreign corporation pays tax, yes, you generally will get a foreign tax credit in the United States for the taxes paid by the corporation. And then there's also a second level of tax when that corporation distributes a dividend to you. There may be a withholding tax imposed by Korea on the dividend, which also should be creditable to the U.S. taxpayer.
Great. Another question has to do with the flat tax rate. So here's a question that says, I've been told that I need to pay the new tax rate from January 2021, basically, increasing this person's, tax rate. When does the 5-year really hit if this person arrived on, let's say, October?
It is counted as a taxable year. So you arrive in, October of some year, 5 years back, then that's, even though you stayed here only 3 months, that's actually 1 year.
Okay.
And then you count that then 1, 2, 3, 4, 5. And then after sixth year, you pay just like any other Koreans. Yeah.
Another question is, this is a U.S. citizen who has lived and worked in Korea for close to 10 years. Obviously, the 5-year mark is done. Hey, which country gets the first taxation right on this person's income?
I mean, so as Paul mentioned, the source is important, where that income is from. If it's a Korea taxes first. If it's somewhere else, the somewhere else taxes, first. And then Korea gives a tax credit when Korea taxes the same amount again. So it depends on, where the source of the income is.
Another question is, we run a liaison office in Korea, headquarters in the U.S. Do they have to pay foreign contractors via the Korean branch, or can they be paid from the U.S. entity?
Oh, that I don't think we can really answer at this setting. That's a very, very, very complicated question involving potential permanent establishment issues and many different things. So that's something we'll try to answer maybe separately.
Another question which I think is important is, I'm a Korean resident with a green card, U.S. green card. For God, to pay U.S. tax return or file U.S. tax returns? What do they do?
So there's this, believe it or not, this happens quite often. And there is, as a green card holder, there's an obligation to file a U.S. tax return every year, even if you're not a resident. There are several IRS programs and other ways to remedy the situation, such as filing back returns, or there are programs, one was called Streamlined, where you could, if you could establish that it was not a criminal intent to avoid taxes, it was an innocent mistake, you can kind of get clean with all of that. Another important rule in this area is there's an IRS policy statement related to how the IRS enforces in this area, and they're only, in general, going to look back 6 years. So oftentimes what we would do in that circumstance is, again, everything is caveated by we need to know all the facts, but filing 6 years of delinquent returns and all the associated international information returns that go with it.
This is where they hire you, right, Paul, as a former IRS expert at Kim Chang? The other question is, I'm a U.S. citizen, lived in Korea many years, and have no interest in ever going back to the U.S. What do they do?
So that's an interesting question, and this goes to immigration law and outside of tax law. So I'll give you a few observations and then talk about tax. If you don't want to be in the United States, you can consider expatriating, and that takes away your rights as a U.S. citizen. For example, voting, free entry and exit, and those are things that tax lawyers are not able to really discuss. From a tax perspective, there is a process called expatriation for tax purposes, which if your net worth is $2 million or higher, you're going to pay what's called an exit tax. So all of the gain above that 2 million threshold would be subject to a tax upon leaving the U.S. So if you've been here a long time and you have significant assets, you're going to have to run through that set of issues if you want to leave the U.S.
Another question applicable to many people here is, my children are Korean citizens. They live in the U.S. and attending university. Do they pay U.S. taxes?
So they are Korean citizens?
Yes.
And no U.S. citizenship?
No.
Or U.S. citizenship too? Then probably then they are in the U.S. With a student visa. Is that right?
Yes.
There are a few types of visas. When you have it and then you stay in that the host country, they don't count that days as when they calculate the measure whether you are a U.S. resident or not. So U.S. says that the 3-year kind of weighted average 183-day rule. I mean, if you stay there for 183 days for kind of 3-year period, there's a slight of calculation, but then, so a lot of non-U.S. persons, like non-citizens, non-green card holders, they have to actually do the counting of the days. But if you have a student visa, that days don't count. So the children, Korean citizen, Korean national children studying in the U.S., they have a lot of maybe income from Korean source. They don't pay tax on that.
Okay.
But if they have a U.S. source, then U.S. will try to tax that.
Okay. Another question is, I'm a U.S. citizen who's lived in Korea for many years, but I decided to leave Korea back to the U.S. and I just sold my house in the U.S. and made $1 million capital gain. What do I do?
You mean before you leave?
Yes.
Before the person leaves?
Because a lot of people are doing that, right?
Yeah.
And
You
I
should
think,
wait.
Paul, this is
You
a
should
question
wait,
more
I
for
think.
you as an IRS expert and Sean in Korea. I guess the question is, can the Korean government come after you after you had left the country of South Korea to the U.S.?
Well, yeah, I mean, so we were laughing. Sell the house after you lose your Korean residence. That's one way. But
Yes,
if it
that's
already
right.
happened, can they come after you? And this applies also to the United States side. There are many treaties other than tax treaties in effect that relate to criminal proceedings and extradition. So if you're, willfully trying to flee a country on a tax obligation, it's you're playing a game. I mean, maybe nobody will ever find out, but if they do find out, they have the ability, the legal ability to come and get you. And I do want to say this, having worked at the IRS for many years in the chief counsel's office, where you make innocent mistakes, the IRS and the chief counsel's office is very lenient. They're not out to get you. They understand that's complicated. And if you come forward in good faith and sort of demonstrate what your problems were and what happened, nothing bad is going to happen other than you'll have to pay taxes and interest, but probably not penalties. Okay. On the other hand, if you cross the line and you go into this sort of area, a criminal area where you're trying to avoid, the IRS Criminal Tax Division works closely with the Department of Justice and the FBI, and it gets nasty very quickly. And those divisions develop and build cases, and typically when they go to court, they have like a 99% prosecution rate. So obviously nobody wants to be in that, but since the question was asked, I do want to make it clear to everybody. Innocent mistakes are fine.
Great. Two last questions. One is, even I just learned about it from your webinar today, about the sunset clause in the $12 million estate tax exemption. Are you aware of any other tax changes on the horizon from the incoming Biden administration that may impact U.S. citizens living in Korea?
So there's several things. We don't know a lot about what the incoming president will do. One of the big questions is, will he, as you allude to, unravel a lot of things that happened with U.S. tax reform, and that has broad implications to corporations, but also individuals in the case of that estate tax provision. More broadly, there's a hope that the Biden administration would work closer with global stakeholders like the Organization for Economic Cooperation and Development, work closer than the Trump administration did. The Trump administration was more, for lack of a better term, tough and not as collaborative. Similar thoughts apply to individual countries. Like, will Biden have, more collaborative policies with China that may loosen some of the trade restrictions and things like that? So we'll have to see where it goes, and we appreciate the question.
And last question, given that this 5-year rule seems to be a top, interest for all of us, are there any tips you can provide to help individuals prepare for their Korean tax? And I think that, we don't have a lot of time for you going into detail, but just big picture, I think it would be very helpful for everybody here as they get into this 5-year zone.
Well, I guess for the 5-year rule, you need to know how that 5-year rule works first. I mean, there's a 5-year flat taxes, from the day you start working in Korea, and then that's 5 years. But then this another 5-year, more general 5-year rule is that the 5 years out of 10, past years. So you need to figure out whether you actually fall into that, meet that the threshold first. And after that, it becomes rather simple, because after that, you are just becoming a complete Korean tax resident, just like anybody else. You have all the information filing requirement, all the foreign source income you earn. You're making money out overseas, and you have to pay tax on that. And of course, the source country will probably tax that same amount, but then Korean government gives a tax credit. So usually there's no double taxation. Right. So after 5 years, you just become a complete Korean tax resident. Yeah.
Right. Well, maybe in the future, AMCHAM can have another webinar specifically about the 5-year strategic planning, exercise. So
Okay.
again, hey, gentlemen and the audience, thank you so much for joining us today. This entire webinar will be available via YouTube, most likely late tomorrow. So please, if you want to listen to it again, we encourage you to do so. You may want to send it to your friends and colleagues who I'm sure are going through similar challenging times. So please do that as well. And thank you again for continuing to support AMCHAM. And thank you, Kim and Chang and Paul and Sean. Have a great morning, great evening.
Thank you very much.
Thank you, James.
Thank you.